So is Meta building a bridge to the future, powered by things like AI and Reels monetization? Or is the recent stock action hinting they're just walking the plank? The stock's been a Wall Street favorite most of the year, but that price chart, especially after the earnings dip, well, it looks less like a simple correction and maybe more like a crime scene. Is this a classic buy the dip moment for long-term folks, or is it maybe time to unfriend Meta from your portfolio? Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today, we're doing a deep dive into Meta Platforms, that's ticker Meta. We'll be looking at this huge conflict between its strong fundamentals and some really catastrophic technical signals. And we're using data captured fresh this morning, November 4th, 2025, around 7:00 a.m. Eastern Time from our research.
Yeah, and we absolutely have to start with the environment today. It's bracingly cold out there for stocks. Pre-market futures are flashing red basically across the board. It's a very clear risk-off kind of mood in the market. And the tech-heavy NASDAQ Q, it's leading the way down, off over 1% already. Think of it like the whole market just decided to pull its winter coat on extra early.
So a general chill, what's driving that?
Well, this macro worry seems driven by a couple of things. First, slowing consumer income growth. People are getting nervous. And second, there's this persistent threat of a government shutdown looming, which, some estimates say could knock a full percentage point off overall economic growth. So when the general mood is this negative, even really strong stocks feel that pressure.
Okay, but despite that chilly macro picture, Meta itself, Wall Street seems scorching hot on the actual business, right?
Yeah.
Our research shows an incredible 85% of analysts covering Meta have a buy or strong buy rating. That's not just consensus, that feels like near unanimity.
It really is. And the reason for that, Vic, it isn't just about valuation, although our research does peg the fair value somewhere around $630 a share. So suggesting it's not wildly overpriced, but it's more about execution. Analysts are pointing to the huge efficiency gains Meta's made, boosting their margins dramatically, and the continued momentum they have in actually making money off Reels, their short-form video. Plus, the company's still innovating. They just rolled out some specific new revenue-driving features for Facebook groups. The foundation looks, rock solid.
Right. Okay, so here's the core problem we need to tackle then. The fundamental story says, stable, growing, looks great, but the price action is just screaming, get out. So if the underlying business is so strong, why did the stock just take such a massive hit? And maybe more importantly, are the big institutions seeing some risk that maybe the analysts are completely missing here?
That is the million-dollar question, isn't it? And the technical chart, which, tracks actual investor behavior, that tells the most dramatic story right now. Every single trend indicator we track has flipped negative. That signals a major structural shift. To put it simply for you listening, the 50-day moving average, that's the short-term trend, it has decisively plunged below the 200-day moving average, the long-term trend. That pattern confirms the path of least resistance for the stock price right now is lower.
And it's not just a gentle drift down, it sounds like it's validated by, a stampede.
Exactly, you nailed it. The move is confirmed by these massive surges in selling volume. And that tells us that big institutional money is just gushing out. This isn't just retail panic selling. This looks like institutions heading for the exits. However, and here's where it gets really interesting, kind of the aha moment. The selling has been so fast, so furious, that one key momentum indicator is now actually flashing oversold.
Way on oversold. So the panic maybe went too far, too fast.
Precisely. That's what an oversold signal suggests. It means the stock's been hammered down so aggressively, so quickly, that it might be trading at an irrational discount compared to its very recent trading patterns. So while the main trend is definitely broken downward, this signal suggests the stock might be ripe for a sudden, sharp relief rally, just because the panic selling itself might be exhausted. We even see a little bit of optimism still hanging on in the options market. The put-to-call ratio is 0.52, which is actually bullish, more calls being bought than puts.
Okay, wow. So we have analysts saying buy, the main chart trend saying run away, and this one indicator saying hold on, maybe a quick bounce. Where does all this leave our strategic outlook then?
Well, if we try to connect all these dots, look at the bigger picture. The sheer agreement among all the bearish technical signals, the broken trend, the huge money outflow, that's just too powerful to ignore right now. So our research leads us to call it neutral overall, but with a clear bearish bias, which basically means if you're a long-term investor thinking of buying, you really need to tighten up your risk management. or maybe wait.
Okay, a bearish bias. So where's the line in the sand? What are the key levels, the battlegrounds we need to watch?
Right. For the bulls, they need to swiftly get back above that $636 to $640 zone. That was a recent support. Now it's resistance. But the really critical invalidation level for this whole bearish bias, the point where we'd say, okay, maybe the fundamentals are finally winning out over the technical panic, that would be a decisive closeback above $660 until and unless that happens. Caution is really the word of the day here.
Got it. So Meta is kind of caught in this tug of war between its glowing Wall Street report card on one side and this price chart that looks like it's been sent to detention on the other. And for the moment anyway, it really looks like the chart that technical reality of institutions selling well, it seems to be winning the argument. The big challenge for you, the investor, is figuring out how long you can afford to wait for those strong fundamentals to potentially take back control. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Always do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.